Hi, welcome back. This is part 3 of chapter 1. So this is page 8. So at part 2 we have discussed a lot of accounting principles and concepts, and actually if you look into detail you can find out that each accounting principle and concept they may conflict with each other. So let's come back to the textbook. The accounting principles and concept may contradict. It means that they are in the opposite. It's not the same with each other. So the following are the example. First one, historical cost and going concern. According to the historical cost, we are required to record the transaction using the original cost. However, going concern concept is say that you should record the transaction on the lower of cost or the realizable value. It means that one is using original cost and going concern concept suggests that we should use the net realizable value. So we can see that historical cost and going concern concept are different. Next, historical cost and realization. Realization concept indicates that an item or a transaction shall be recorded when it is virtually certain and must make sure that the amount can be collected. However, in addition, only the collectible amount shall be recorded in the accounting record. For example, when you have allowance for doubtful debts. This contradicts with historical cost concept because historical cost concept assume that we shall record on the original cost. Next, completeness and materiality. According to the completeness concept, we assume that all the business transactions shall be recorded. Completeness say that all the transactions shall be recorded. However, according to the materiality concept, it say that only important and significant transactions shall be recorded. For example, let's say you buy a pen. Let's say 50 cents. According to the completeness concept, it say that yes, we need to record. Why? Because all the business transactions shall be recorded regardless the amount. However, according to the materiality concept, it say that I only need to record important or significant transaction. Do you think that a 5 cent is very important for a business? Let's say your business is very big. No, right? So this accounting concept and principle, they are contradicting to each other. Completeness say yes, but materiality say no. Next, objectivity and prudence. So objectivity concept say that when you prepare the account, you shall free from any bias or profits. However, the prudent concept advise that accountants should select the option which result in lower profit. Objective say that you cannot choose. However, prudence asks you to choose the option that result in lower profit. Again, they are contradicting to each other. And last one, accrual and realization. Accrual concept indicates that the income and expenses shall be recorded in accounting when it is earned and incurred. I think we have discussed it before, right? No matter you paid or not paid, as long as you incur the expenses or you earn the money, you shall record in the account. However, realization suggests that only record the transaction when it is virtually certain. It means that when you can confirm receive or when you can confirm paid, then you only record in the account. So these two is contradicting to each other again. So those are the example of conflict in the accounting concept and principle. So we have a question to solve. What is the solution of the above conflict in accounting principle and concept? Or we can change the question: when you have conflict in the accounting policy or accounting principle and concept, how you solve the issue? So the solution is like this. When you have conflict in accounting principles and concept, choose the one result in best benefit to the user of financial statement. This is the solution when you have conflict in accounting principles and concept. Next, the next section we are going to discuss what is the accounting standard and the pros and cons for accounting standard. So what is accounting standard? Accounting standard is a set of guidance of regulation for the preparer or user to assist the preparer in preparation of account and to assist user to understand the language in accounting. So for the accounting standard, we have two types. The first type is principle-based accounting standard. For principle-based accounting standard, it provides a basic guideline for accountant to follow in the preparation of account. Accountant is not required to comply with principle-based accounting standard as long as they can justify that the use of another accounting standard offer a higher quality in the financial reporting. Example of principle-based accounting standard are International Financial Reporting Standard and International Accounting Standard. For principle-based accounting standard, you are not required to 100% follow. They are just providing you a guideline for you to follow in the preparation of account. If you think that their accounting standard is not good, are you able to choose your own? Yes, you are able to choose your own accounting standard. You can choose not to follow as long as you can justify that the use of another accounting standard offer a higher quality. This is principle-based accounting standard. Next, rule-based accounting standard. For rule-based accounting standard, it required the accountant to comply with the rules and regulation in preparation of account. Can you tell the difference? The first one, principle-based, only offer a guidance to follow. However, rule-based, you are required to follow. You are required to comply. Rule-based accounting standard offer less judgment used by accountant in preparation of account. Non-compliance can be considered as breach of law. Example of rule-based accounting standard is United States General Accepted Accounting Principles, US GAAP. So under rule-based accounting standard, this is a law. You must follow during the preparation of account. If you are not follow, you are considered breach of law. Of course, when you breach of law, you will have penalty or even in jail. So one question, in Malaysia, we are following principle-based accounting standard or we are following rule-based accounting standard? The answer is for Malaysia, we are following principle-based accounting standard. You are not required 100% follow, but you are advised to follow because they offer the most appropriate guidance for accountant in the preparation of account. Next, we are going to discuss what are the benefits, advantages, or disadvantages for accounting standard. Advantages of accounting standard. Accounting standard can improve financial statement comparability between different companies. So if every company in the world will follow the same standard in the preparation of account, of course, this is more easy for us to compare between each company. Next, reduce the cost to preparer in terms of comply and user in terms of understanding different accounting policy and definition, as there are few choices available. So for the preparer, if you want to come up your own accounting standard, this may be very costly and very timely. You have to spend many times in the accounting standard. But if there are a set of accounting standard for you to follow, of course you can save the time in develop your own accounting standard. And for the user, it's very easy for you to understand if everyone using the same accounting standard. Next, by having a high quality accounting standard to follow, this can improve the quality of financial reporting. So those are the advantages to having an accounting standard. Next, we are going to discuss the disadvantages of accounting standard. Different accounting policy can still be used by which may lead to confusion. Inside an accounting standard, they may have different options. For example, in the depreciation, you are allowed to use straight line method or reducing balance method. You are allowed to do the selection. So this selection still will result a difference between each company. So it cannot totally solve the issue in the different accounting policy. Next, accounting standard may not offer guidance in all situations. Accounting standard, they can only offer in general situation. So we only use the general situation to handle the account. But in some rarely situation, accounting standard may not be able to offer a solution to the accountant. Next, management may misinterpret the accounting standard in the preparation of account, so lead to misreading to user. Accounting standard is a set of document. So when the accountant or the management, they interpret the accounting standard wrongly, they may prepare the account in accordingly. So this set of account may misleading the user. And next, conflict between new and old accounting standard. Accounting standard, they will keep develop a new standard to overcome the current situation. So sometimes the old accounting standard and a new accounting standard, they may conflict with each other. Next, accounting base and accounting policy. So what is accounting base? Accounting base are the various possible method of applying accounting concept to the preparation of financial statement. For example, the company can use straight line method or reducing balance method in the depreciation of its fixed asset. What is accounting policy? Accounting policy are the specific method chosen and applied in the preparation of financial statement. For example, the company has decided to use straight line method in the preparation of fixed asset. Note that the application of accounting policy shall be consistently applied. Valid reasons are required, and retrospective amendment of financial statement may be needed for changes in accounting policy. So we use a simple diagram to explain accounting base and policy. So according to accounting standard, they will give you option in certain methods. For example, in the company fixed asset, you are able to use straight line method. You are able to use reducing balance method. You may not understand what are those methods at this moment, but don't worry, we will cover this in the chapter 5. So back to here, accounting standard, you are able to choose between each accounting standard. You can choose either straight line method, you can use reducing balance method. So here we call this as accounting base. It means that the option for you to choose. But let's say if the company conclude that I want to use straight line method for my accounting, and this straight line method will become what? This straight line method will become the accounting policy of the company. So let's repeat here. The accounting standard offer option for you. So those options we consider as accounting base. After you select the option, and this option will become your accounting policy. And according to accounting standard, we cannot simply change the accounting policy. The accounting policy shall be consistently applied. If you want to change, you must offer a valid reason for the changes. Next, in this section, I'm going to share with you what is the difference between financial accounting and management accounting. And of course, for this paper, is FA1. So we are talking about financial accounting. Financial accounting is concerned with the preparation of financial statement to user in relation to the financial performance or position of the entity. So financial accounting tends to be prepared on a periodic basis based on the past event, transaction, and historical data. We comprise mainly on financial information. And lastly, presentation is required to comply with applicable accounting standard. But for management accounting, they have a different focus. Management accounting is focusing on analyzing the day-to-day operation. And this is for management used in decision making. Management accounting tends to be prepared based on the need of management. You are not required to prepare on a periodic basis, let's say 1 year, one times or what. You prepare when you need. And this is more focused on the analyzing on historical information in order to assist in future planning. Management accounting mostly used for planning purposes. Next, comprise both financial and non-financial information. For example, you in the management accounting, this is not only focused on how many profit or loss you make on the business. They will talk about what is the efficiency, what is the percentage you use the asset or whatever. And next, no standard presentation format is required. And in this subject, we are focusing on financial accounting. And the management accounting, you will cover by another lecturer. Next, the last section in part 3 and chapter 1. The structure of private sector business. So in Malaysia, we have many forms of business. For example, you have sole trader. So what is the key feature for sole trader? You have only one owner. For partnership, you have more than one, it means at least two. For limited liability partnership, similar to partnership, we also have more than one. And for limited liability company, we base on the number of shares. So let's go through one by one. Owner. For sole trader, you have single owner. Partnership and limited liability partnership, we have 2 to 20 or more than 2. And for the limited liability company, we base on the number of shares to determine the owner. Liability. Liability here discussed when the company is not doing good and the company is going to liquidate. If the liability of the company, who need to bear the responsibility? For sole trader, the liability is unlimited. It means that if your business making a lot of losses, you want to close the business, but the owner still required to make the payment, we can put in an illustration. For example, you are the owner of the company. This is your business. And your business, you owing to, for example, your supplier 100,000. And because the business is not doing good, so you decided I want to close the business. So question, since the business is closed, as an owner, do I need to pay the amount owing to the supplier 100K? Assuming if you are a sole proprietor. The answer is yes. As an owner, you have to pay on behalf of the company to your supplier, even though your company is closed. Why? Because under the sole proprietorship format, your liability is unlimited. It means that all the losses or all the debts incurred by the company, owner is required to pay. That's why we say that for sole trader, you have unlimited liability. This also similar to partnership. However, the liability is limited in a limited liability partnership format or limited liability company. As you see, they already mentioned that their liability is limited. So limit on what? Limit on the capital. Limit on the capital that you invest in the business. Next, whether a company is a separate legal entity. For sole trader and partnership, the answer is no. For limited liability partnership and limited liability company, the answer is yes. So let's use another example to illustrate the separate legal entity. So imagine you are the owner of the company. You sell a product to your customer. Let's say you are selling food, but this food have problem. When customer taking the food, they are admitted to the hospital because your food got problem. So now your customer, they're planning to sue you. So the question is, when the customer want to sue the company, is sue to the business or sue to the owner? I repeat the situation. You as an owner, you have a business, and this business you sell product to your customer, but your customer, they plan to sue because you are providing not appropriate food to them. They are admitted to hospital, so they are not happy, they want to sue you. So tell me, customer is sue to the business or sue to the owner? This very depend on the business structure. If you are sole proprietor, if you are partnership, is sue to owner. If you are in a limited liability partnership, you are in a limited liability partnership or limited liability company, they have to sue the business. So this is the concept of separate legal entity. Either is sue to the owner or is sue to the business. If you are sole proprietor or partnership, when your customer want to sue you, it will sue to the owner directly, because sole proprietorship and partnership, they are not a separate legal entity. However, if you are in the structure of limited liability partnership or limited liability company, if the customer wish to sue you, they cannot sue to you directly, they have to sue the business. So this is the difference between sole proprietor partnership and limited liability partnership and limited liability company. No for the sole trader and partnership, and yes for the limited liability partnership and company. Next, audited financial statement. Audited financial statement means that whether the account have to be audited, have to be checked by auditor. For sole trader, partnership, and limited liability partnership, you are not required to audit. However, for a limited liability company, you have to audit. Difficulty in external borrowing. Here we discuss whether the company is easy or whether it's difficult to get the fund from external. Who is the external borrower? The example is bank. Whether it's easy for you to get the loan or the borrowing from bank. For sole trader, partnership, and limited liability partnership, the answer is hard. Very hard for them to get the loan from external party. However, for the limited liability company, the answer is easy. Easy for them. Why? Because of this. Imagine if you are a bank. When people come to borrow money from you for business purpose, what will you ask? Definitely you will ask the financial statement, right? In part 1, we also discussed bank will need the financial statement to assess the creditworthiness and the ability of payment. So when you get a set of account, you wish that the account is being audited or not audited? I think the answer is audited, right? Because when the financial statement or the account is audited, it means that someone, a professional guy, auditor, have done the checking. They already ensure that the account is faithfully presented, it's true and fair, we can rely the information. So as a banker, they will prefer the financial statement is to be audited. That's why they are more willing to borrow the money for the limited liability company, because they are required to carry out the audit on the financial statement. Because imagine if the account is not required to audit, can you simply change the information? Can you simply adjust the sales amount of the company to make sure to show that the company is earning a good profit? I think you can do so, right? Because the account is not audited, it's not checked by the auditor. Because of this, when bank come to borrowing, they will prefer limited liability company more, because the account is being audited. They are more confident to borrow the money to the limited liability company because they can access the financial statement. Next, difficulty information. For sole trader and partnership, it's very easy for you to form the company. And for limited liability partnership, the difficulty is moderate, and for limited liability company is more complicated in setting up. So that's all for part 3 in your chapter 1. So if you have any question about your part 3, you can leave me a message, or we can discuss in the RMS discussion group. That's all for chapter 1.